we are here to help entrepreneurs either start business or grow your already existing business. I'm here with an entrepreneur guru, my friend Liddell.
Typically, tangible assets hold their value versus non-tangible assets. I'm not against stocks at all, period. I just like for my money to be backed by something that's tangible, physical, that I can go see and feel it's mine.
What it do, y'all? It's your partner, and I'm back for another edition of the Countermove here on Thursday, guys. So thanks for tuning in with your partner, man. And again, before we start, take that picture for your mom and them. I never get tired of looking better than you. It's all good, baby. But now, guys, this is going to be probably a fun-filled but pretty serious conversation that we got to have. Okay, we're going to talk about realistically, guys, the state of the U.S. economy. Uh, we have to begin to have a realistic conversation about this now, not because of the elections at all. This is because there's a lot of things that people are feeling due to what's going on, and you get a lot of spin from a lot of people. And my intention is not to spin; it is just to present to you the actual facts and also as solutions at the end as well. Okay, guys. So I always say this up front: if you're looking to be a part of a discussion that results in a debate, this is not the show for you. So you can go ahead and bounce. But for those that actually want to kind of learn a little bit and reason together, lean in a little bit, but willing to have those tough conversation. Hey man, let's dive into this thing, guys. All right, man. So let's look at this real fast, guys. Let's go right into this really quickly. The first thing we're gonna focus on, guys, is really the elephant in the room. It's inflation. Inflation, guys, is really at an old time high. I thought it would be wise for us to look at how we got here and really to begin to look at the numbers, the details into this. All right, guys. So let's look at this real quickly here. All right. This is a chart showing the actual inflationary rates, guys. I want you to take a look at this. Look at this deeply. It's going from January 2020 to September 2022. Okay, so if you look at this, it's very simple to follow. You have January of 2.5%. They go down to 1.5%, then down to 0.3% in April 2020, and then 0.1%, pretty low back then. And then you have 0.6% in June. There's July, August, September, October, November, December. Now, this is under the Trump administration, okay? But during this time, I do believe in 2020, you had COVID situation going on. So you're beginning to see it go up and up 1.7. Now we in January of 2021. Now there's a new administration coming into play, okay, guys? Which is fine. So now they grab the range at 1.2 to 1.4%. So now we begin to see it creep up a little bit, 1.7, 2.6. Then you have in April 4.2, 5%, 5.4, and July 5.4 again. So it even there. August 5.3, September 5.4%. Okay. October 6.2, November 6.8, December 2021 7%. You see us going up. And then you look at January 2022 this year 7.5, February 7.9, March 8.5, April it went down to 8.3%, May 8.6%. June, 9.1%. July, down to 8.5%. August, 8.3%. And of course, September, 8.2%. Okay, guys? So you begin to see this. It's important to look at numbers. You begin to see from a 2.5% up to a 8.2%. And you begin to see within the range of, let's say, May on up to December. That was kind of the COVID years a little bit when there was a lot of printing going on as well, but then the printing never stopped. And as you can see, it keeps going up and up and up and up and up. And it came down a little bit, guys. But I wanted you to see exactly what was going on with the inflation rate. You get a lot of spin everywhere else. I pray that I'm not the one that gives it a spin at all. But this is where it is right now when it comes to inflationary rate. Now come back to me real quickly here. Uh, what I want you to do now is, as we are walking through this, let's look at how did we get to that high inflationary rate? How do we get there? We know it's due to printing. Okay, you've seen me play it several different times. The actual definition of inflation. Inflation is too much currency flowing to too few goods. It's a simple definition. I'm not going to play the video again. You've seen it too many times. All right. But now what I want to do is I want to do a little something different. I want to bring in some experts as well. But let's go to the next thing we're going to focus on now, which is energy. Okay. Energy is a big backbone of our economy. It's one of the big backbones of our economy. Okay. So let's look at how we actually got here. Okay. It's important before you can know exactly where you're going. It's important for you to know where you came from, how you got to this point. Okay. So let's go here. I'm going to play for you guys exactly how he actually got here. Okay, so this is the U.S. Our current U.S. administration, Secretary of Administration, right here. Okay, she's going to let you know the actual intention or the philosophy that the Biden administration is pushing behind energy. Here we go.
Plan to jumpstart energy production across America.
Here's the Biden plan. I'm here at Glasgow. The Biden plan is to diversify and to make sure that we move in a direction of clean energy where we're not reliant upon cartels and we're not reliant upon geopolitical adversaries who may be creating choke points for our ability and our people to be able to access energy. So that's obviously a longer term strategy, and we will continue. This is why this is called a transition.
Right.
Let's just say.
So the key thing is she's saying it's a transition, okay?
That it is clear that the Biden administration believes we have to move away from fossil fuels and coal.
What he communicated on. So that was me, guys. Don't mean to play me again, but that was me, guys. And so it's very clear that the intention behind our current administration is they actually wanted to transition away from fossil fuels. In other words, oil, crude oil, and natural gas. Okay, we're swimming in oil and swimming in natural gas. Well, their intention is they wanted to move away from that. Okay, now let's see exactly what they have done to be able to move away from that. Okay, let's see exactly what they have done. Let us see here. Let's go here. Boom. Here we go. Let's see exactly what they've said. Not my words, their words. Okay. Boom. January the 22nd, 2021. That is 2 days after he is sworn in as president. 2 days. What did he do? Biden halts oil and gas leases, permits on U.S. land and water. Biden makes sweeping changes to oil and gas policy. December 16, 2021. Okay. Wall Street banks facing new pressure to cut fossil fuel financing. This is February 21st, 2022. Okay. Biden administration freezes new oil and gas drilling leases. May 12, 2022. Biden cancels offshore oil leases sales in Gulf Coast and Alaska.
Stop oil and gas drilling in the outer continental shelf. Mr. Biden has already imposed a de facto moratorium on new offshore leases. Okay, but progressives want Biden to.
So guys, on that one is you clearly can see that that the Biden administration really once he actually got in, it was clear as we heard our secretary say they wanted to transition away from fossil fuels. Okay, that's it's crude oil and natural gas. Okay, so and also now you saw also in the dip. I want to be actually clear. Okay, I want to be very clear. Let me go back to this graph real fast. Is I want you guys to see here. Let me go over here real fast so you guys can see a better layout. Okay. If you look over here real fast, guys, you actually see that there's a dip here a little bit. That's a dip here. Excuse me. And there's a dip also down here. So a lot of people say, well, that's a good move. And again, I like for the inflation rate to come back down. But what may have caused that to actually happen? Well, President Biden did come out and say that he actually wanted to, he was releasing the strategic oil reserves. I believe he did it twice, I believe. And he did that because he wanted to address the high oil prices, okay? And so let's see exactly, let's look at it and see, was that wise to do, number one? And what was the true intention for the strategic oil reserves to be released, okay? Let's go back to that and see what's going on there. Because he did it specifically for the reason of lowering down oil and natural gas. Okay, guys. So let's see what the true intention of releasing those oil reserves was for. Okay.
Be concerned about the oil being sent overseas versus it being here right at home.
Well, first off, let's recall what these reserves are actually in place for. We have these strategic petroleum reserves in order to help us get through a crunch, not of high prices, but to get through a crunch. Let's say we had a hurricane or an attack on our infrastructure or a period of war where we couldn't actually get oil out of the ground and through the refineries. That's why we have these reserves in place. These reserves are not there to help any party, whether it's Republicans or Democrats, lower gas prices or oil prices. That's number one.
The key term is strategic oil reserves. So, guys, let's be very clear here. Let's be very clear. The role for the strategic oil reserves is not at all, not to lower down oil and gas prices, okay? It's there for wartime decisions. In other words, we need to tap into that reserve, guys, for us to be able to curtail that. Now, by doing that, did he get a short-term type of scenario there? Well, let's go back. Let's go back to the graph, guys. He actually did, but again, its intention was never to be used to lower oil and gas prices. Okay, that was never its intention at all. So, because of this, what's happened now? Well, let's look at it and see, guys. Before we go there, let's go over to see the oil and gas prices. Okay, guys, let's go over here. As you can see, this is from 1950 to 2020. Okay, so it's not even 2022. Actually, 20 to 2020 it is. So if you look at it, let's begin here, guys. At here we go. I like this graph, guys. Let's go to, let's say, November 2021. You see in June it's $42.20. Okay, July you at $46.50. Let me see if I can make this bigger for us real fast. I can. There we go. Then you have let's go back over here. April 2020, $21.82. This is the price of crude oil barrels, okay? Oil barrels, okay? $46.15 in July. Then you have, let's go back to October, $40.80, okay? December, $55. It's beginning to go up a little bit, okay? So now we in January. In January, it's at $59.25. A new administration is now intact. Now, why am I showing you this? We just saw the intention of the administration was to transition off of fossil fuels. It was a trend. There was the exact words to transition. That was their words, and they begin to tap into the strategic oil reserves. Let's see what's going on. So now, when the administration changes, the oil price is at $59.25. Let's keep it going. So watch it go up. 69, it's 37. We had $70.64, $73.15. All right, $80.23. That's June 2021. You see, it's going up. $80.38. So we had in October $89.67. So now we had November 70. So we're down a little bit. All right. Now back at 80. All right. So now let's go to January. So January is $93. So he got it at 59. When the administration changed it at $59 has been changed. Now now it's so we had $93.09. Okay? Because there's a policy change now. There's a policy change now, and now it's unfriendly for the oil and gas companies to make any investments. I'm gonna go into that in a second. Okay. Let's keep it going. Tonight, 93rd. Now, and so now we in March. We at 103.49. So let's keep it going. All 116 May. So now we're back at 98. July. So it's going back down. Okay. 83, 89. October, 86. Okay, it's 86. So in October of this year, we're at $86.18. Okay. So we're beginning to see kind of the pricing there. Got it at 59, went as much as 116. Now it's at 86.18. Okay. But at the exact same time, what I want you guys to see is it was very evident to understand and see that our current administration, they realistically made it very clear that they actually wanted to transition away from natural gas as well as crude oil. Okay. But remember, he tapped into the reserves, which was not the intention for the reserves. There's also another problem when it comes to this type of policy. Okay. Let's look at it and see, guys. All right. Let's go to Bloomberg. Bloomberg. We now, guys, actually have a shortage now in crude oil. I'm sorry, in diesel. Okay, let's listen to this report. Let's go.
It is a huge problem. In fact, if you look across the commodity spectrum, we've been arguing there's commodities that are in a good situation, some that are in a bad situation, and some that are in an ugly situation. Mm-hmm. And diesel definitely qualifies as an ugly situation commodity because of three main reasons. Reason number one is that we've had a huge disinvestment in refining capacity because
remember, now this is Bank of America Securities. Okay, there's been a de-investment, guys, in refineries. What that means is because of there's a change in policy from the administration. What's happening is it's not an inviting environment for oil companies to make additional investments. Okay, because it's clear that the administration wants to transition away from fossil fuels. This is not me saying this. This is the Bank of America Global Research Head of Global Commodities and Derivatives Research. This is Francisco Blanch. This is not me. This is what he's saying. All right.
Because we had weak demand throughout the last couple of years during the pandemic, and then of course we were all moving quickly to an electric vehicle future. That's
electric vehicle transition. There we go.
Maybe taking a little longer than we expected, as we've learned with Tesla. But so I think
look at that graph. Fuel in inventories lag seasonal norms. Look at that graph. This is from 2017 to 2021. This is not. I'm not saying this. This is on Bloomberg, guys. Look at this.
I think we've lost about 2 million barrels a day, 2% capacity on refining.
2 million barrels a day.
That's now coming back to haunt us. Second factor is the very, very high natural gas prices globally. Remember, high gas prices hurt refining margins because gas is a key input into the refining process. This is what
now we just looked at. He's talking about the oil, the barrels of oil being sold on a global scales. He's talking about. We just saw that graph.
We used to burn crude oil to create diesel. Essentially, that's gas. Mm-hmm. So that's not helped us either. And then the third factor, really on the supply side, which has been a big problem, is sanctions on Russia. The U.S. was the first country to impose sanctions on Russia and diesel. Then the UK, and now, of course, over the next couple of months, we're going to see Europe doing the exact same thing. So, and Russia is the world's second largest exporter of petroleum products, including diesel. So that's where we are today, guys. This is very problematic.
He said this is very problematic, guys. I believe they said we have 25 days left of diesel fuel. But now what is diesel fuel? Before I go there, let's keep listening.
The urgency here is pretty incredible, just days of diesel supply.
Days.
What does this mean heading into the midterm elections and the broader inflation story?
Okay.
Well, look, I mean, I think one very important message is hopefully the U.S. government does not take the steps to restrict exports because, again, Europe is essentially trying to sanction Russian imports of diesel. So, and of course, we've already heard from the UK regulator, where you guys are at, right, that there could be blackouts during the 4 and 7 p.m. on cold winter days. So Europe needs the energy. I realize high prices do not help anyone. But ultimately, prices are a mechanism.
That, guys, this is the pump prices near $4 ahead of the election. Okay, forget about the election. Let's look at the price point. 2004. Look at that. $2. 2006 over $2. 2008 went up a little bit, $3. Okay, 2010, 2012. You see that? Look at this. Look at this. This is crazy town.
Mechanism to spread around the limited available supplies, and that's what we have right here, right now. Wow. We need to let prices do some of the work on distillates, and I think it'd be very damaging to start using non-market measures such as restrictions in order to support U.S. consumers, but at the same time really hurt European consumers that are already facing a very dire situation.
So it sounds like what he's saying, guys. Come back to me. What he's saying. What he's saying, guys, is this here is he was saying that hopefully the U.S. government does not stop exporting. Okay, and so if we saw in one of the previous clips that we actually ran was there's a lot of executive orders being done to restrict a lot of leases. Okay, I know we've heard a lot of people saying, well, the Biden administration has approved several amount of leases, but the problem with that is those leases were on dry lands. It takes an immense amount of capital to pump a lot of oil and gas, guys. I mean, there's a lot of stages that go into that. Okay, so there was some restriction of leases. Okay, so the high regulations. Okay, which is not inviting for oil and gas companies to make any investments. Think about it. If you ran a business, no matter the industry, and what's happening is the government is really highly regulating your industry, or maybe even high taxing your industry. Really, I'm gonna leave just the regulations. Would that be inviting for you to invest your capital? The answer would be no, at all, because the very entity that's needing your products is restricting you or putting more regulations on you, which invites in lawsuits all day long. So not only are you getting regulations from the federal government, but also those regulations, if you don't meet them, invites in additional entities outside of government to sue you. So there's a legal cost to this as well. So, guys, it's something. So, I want to dive a little bit more into the energy section as well, because of the fact that that's really one of the big reasons, as we heard the Bank of America Global Research Head of Global Commodities say. Francisco talked about that. So now, guys, let's get into my discipline. I think the next place we need to go to is real estate, guys. Okay, real estate. I think real estate, guys, is a is a big problem now because of the fact that what we see a lot of higher interest rates. Okay. Same principle, guys. Whenever you have an environment that attracts capital, capital will be invested. Okay. Regulations can then be removed. Not saying that there's any regulations in real estate. I'm just talking about the regulation of a high interest rate. Okay. Capital can be invested, which can then create jobs. People can then start businesses, which then creates jobs. People then buy houses, buy cars. We're in a debtor nation. So when you're in debtor nation, it's imperative for the number for money to be flowing, what they call cash flow. Whenever there's not any cash flow going, that's when you begin to see a lot of governments begin to turn on those printing presses to try to manufacture those cash flows, and that's never a good idea in the wrong context. So let's go, guys, over to. I want to invite in some additional experts concerning real estate, and this is Patrick McDavid and the Valuetainment team did a phenomenal job talking about the real estate sector, and I want you guys to pay specifically attention to this first video is going to be talking about the mortgage rates, guys. Remember, I was the one that has been saying for a long time that interest rates are going to go over 10%. I'm saying 13+%. I say that, guys, because in the private sector, it was the secondary sector when it comes to real estate investing, we're already over the 10%. You're looking at 10 and a quarter, 11.5%. Okay, this is on bridge products right now, guys. Now, and so if it's there in the investment in the investment environment in real estate investing, it's sure enough going to come on the retail side. But enough of me talking. Let's go right into this, guys, real fast. Let's go ahead and get it. And I want you guys to pay very attention to what he's talking about. Okay, pay very much attention to what he's talking about. Here we go. Let's go get this out the way. Let's go get it in. Let's go.
I had a guy call me from LA, and him and I are having this conversation together. He says, look, do you have any interest of ever getting to the mortgage business? I'm like, are you serious? He's the top mortgage guy in LA, in Glendale. He says, do you have any interest of getting to the mortgage business? I said, I'm good, man. I don't have any interest in business. That, you know, when it's doing so well, you can make so much cash. I'm not interested in cash. I'm interested in equity. I'm interested in building the company.
Listen to what he said. He's not interested in cash because cash is trash. But anyways, he says, I'm not interested in cash. I'm interested in equity and building businesses. I want you to burn it on your brain. Equity and building businesses. Let's go.
He says the following to me, flat out. What I liked about him is he had zero ego. He says, Pat, I don't care what anybody's telling you. This is a different guy. The other guy I spoke to. He says, mortgage refi business is down 90%.
90%, guys. Refinance is down 90%. Cliff was saying this on a Real Estate Live Friday. They just came to a screeching halt. It's gone. 90%. This is the top mortgage broker in Glendale, California. 90%. Crazy.
90% is down. We're doing no refis. We're doing none of that stuff.
None.
Do you have the Yahoo Finance article about Las Vegas, how Las Vegas Board of Realty, they asked them, they said, so what's happening with, because, you know, the way to judge it is to find out the Board of Realty in each city and state and how they're doing. And a lot of times they judge it based on Las Vegas. So watch this article here.
Here we go.
If you can zoom in a little bit more so we can read it a little bit more. Okay. Housing market activity. This is from 6 days ago. Housing market activity is crashing and it threatens to push U.S. into recession just like it did in 81 and 2008. Now go up.
Told you. I do.
If you look at the data, there you go, the middle. Zoom in a little bit. Las Vegas is one of the leading indicators for home price action in the housing market like we saw in 2008. And the frenzy, recent frenzy, we are absolutely feeling the heat here. The buyer pool has, for the most part, dried up. Says real estate agent in Las Vegas to Fortune, go a little lower. Go a little lower because now they're talking, keep going. Story continues, keep going. Right there. Realtors are feeling it big time as well. I put a call into the Greater Las Vegas Association of Realtors. An employee I spoke with said that they were averaging 300 new members every month, which means like 300 new realtors every month. This month, she has estimated 120. However, she's been processing about 30 realtor withdrawals a day. Not a week. A day.
That's 900 negative.
A month, Tom.
Come on, y'all.
That means every day around 30 real estate agents in Las Vegas alone are calling it quits. Okay? And if
calling it quits, guys. 30 agents a day.
If you go a little lower, she'll talk about the fact that 38% is down. Look for the number 38%. Keep going. Anyways, there's a 38% number about what's happening with the refi business. So it's a very interesting market we're in right now. Different economies are feeling it. People are feeling it. But a lot of times people who don't want to talk about what's really going on with the market, all they're talking about is unemployment.
Here we go.
And the unemployment numbers are going to be felt next year.
Next year, yes.
A person asked me a question on Twitter. And Jed, you were asking me this question. I'll say this and then we'll toss it around to the rest of you guys. Is this a good time to buy? And my advice is very simple. If you're thinking about buying a house today, buy a house today. But make the offer you would make a year from today.
That's correct.
So if you're buying $1 million home, make a $770 offer. If you're buying a $600,000 home, make a $490 offer.
Because you can, guys. You can do that now because of the fact that the buyer's pool is dried up. The seller just wants to sell. They even give you credits to buy down your rate. I'm giving you a little too much game. Let's keep going.
If you're buying a $450,000 condo or home in certain parts of the country, make a $370 offer, but do not make the offer you would make in today's economy because there's still room, I believe, for these values to go down the next 12 to 18 months.
Here we go.
Yeah, Zillow is showing, this is the average run-up of the last year. And so we don't want to say the address or anything on here, but you can take a look at that, Pat. You see that lump, that skyrocket right there over the last 12 months is an illusion. So you have 5 years of some modest growth, 2-3%, just growing along. See there? And all of a sudden, wham, we print money, the asset changes. So let's go take a look at this house. What was it, October of 21?
1.3.
Yeah, so right now it's at 1.8. It was 1.3, and then go back to October of 20.
880.
Now, guys,
see that where it had been. There it is. So if you were going to go buy this house right now, you would go in there and say probably 1.1.
Yes,
exactly. I'd be making
$1
million offer on that.
That's exactly your advice, Pat. Is
1.4 to 1 million.
I look at it this way. I did a little research for some numbers, or some basic numbers. I'll do this really quick.
Watch this, guys.
Right now, let's say someone was buying a $500,000 house.
Listen to these numbers, guys. I want you to listen to this.
That's it. And you're going to do a 30-year fixed, and you're going to put 20% down. So standard deal.
Yeah.
In March of this year, you would have had a 3.5% mortgage or an $1,800 payment. Reasonable, for a family.
Watch.
Right now at 7.5%, that's $2,800, up $1,000.
Crazy town.
10.25%, where you and I both think this is going, it's double, $3,600.
Oh, it's going there.
So
they're already saying that it's going to go to 10. They're saying that it's going to go to 10 and a quarter. I'm saying that I'm agreeing with them, and in the investment arena where I'm in, we're already there at 10 and a quarter. We're already there. We're going to get there. We're already there. Keep going.
So the buyers are being crushed. Now let's go the other way. Let's say the 1,800 was all that I could afford as a buyer. When the interest rate's at 7.5, the $500,000 house I can afford, I can only afford a $325,000 house. So my buying power is down almost 40%.
Buying power down 40%, guys. I want you to sink that into your head. Buying power is down 40%. Wow.
So what you have right now, if you are out there and you have to change jobs, you're being forced to go to another city right now, I would seriously consider not dumping the house you have, lease the house you have, because you're not going to be able to sell it right now. The price is going to come back down. Yes. But where you're going, the interest rates are so high. So if you sell, where do you go and what do you buy? Your payments.
You know what confuses me is the following: those who are delusional because they're in the industry and they're saying that's not going to happen.
Yeah,
there's a very big difference between power of positive thinking and not understanding that the paranoid survive.
That's correct.
I believe you should read both books simultaneously. Read the book Power of Positive Thinking. Because it's good to have a positive attitude, but do not be delusional because you're in real estate and mortgages thinking, no, it's not going to happen. Year ago, rates were roughly 2.9%. In May, when Dave Ramsey called it fear porn, rates were at 5%. And today, rates are 7.5% for 30-year interest. And everyone's saying, it's not going to go to 7.5%. Never. What are you talking about? Do you realize from 1981 or 82, I don't know what the year was, for about 9 years straight, interest rates in America were above 10%.
Guys, I want you guys come back to me for a brief second, guys. Do you really believe that? Do you agree with Dave Ramsey that this is fear porn? Well, if your answer is yes, stay tuned here real quickly. you're going to begin to see, okay, the numbers. Numbers, okay? Not emotion, not hope and dreams, numbers. I don't want you to give up your hope and dreams, okay? But I want you also to deal in reality. Let's go back to the clip, guys. Almost done. Here we go.
Yep. Can you pull that up, please? Do you realize this is the part where people are absolutely delusional. Go to the rates I sent you.
You go to rates.
No, it was one that just showed the charts. There you go. That's the one.
Yeah, this is Paul Volcker's Endless Halloween.
So check this out. Zoom in so everybody can see. Let's first look at the first chart to the right, which what we've been used to for the last 20 years. Yeah, go to the right. No, don't worry about the stuff on the left. Okay, so what is it right now? Go a little lower. Go a little lower. Okay, 2021, 2.96.
Look at this. Watch this.
2010, 3. 39, 45, 39, 36, 38, 41, 39, 36. Oh, rates are cool. This is what we're used to. This is BS. This is a lie.
Yes.
44, 46, 5. This is a lie. Then it's real. 6, 6, 6. Keep going. 6.3, 6.4. Go to 2005. Okay, 5.8, 5.8, 5.8. These are numbers that we need to stay around. 6.5, 6.9, 8.
That's correct.
Now watch. This is 2000. We're at 8, 7.4, 6.9, 7.6, 7.8, 7.9, 8.3, 7.3. For a straight decade, it's around 7
Look
plus,
at this.
right?
Look at this.
Now you got 1990. Just 32 years ago, it's at 10.13. It'll never crack 10%.
Here we go.
It won't happen. Okay, go to 1989. Let's look at 89. Now watch what happens. So that's
Look at
2
this.
years, 3 years, 4 years,
Look at all the
5,
tens.
6, 7, 8,
Look at
9, 10, 11. Keep going. 11,
Wow.
12.
Wow.
12 straight years. 30-year fixed rates were above 10%.
Crazy.
Let me say this one more time. For
guys, let me go back. Guys, look at this, guys. Look at this. Look at 10.2, 10.19, 12.43, 13.88, 13.24. But we're not going to 10 though. 16.04, 16.63. Look at this, guys. Look at this. This is for real. This is for real.
For 12 straight years, 30-year mortgage rates were above 10%, and people are saying it's not going to go to 10%. Brace for impact, folks.
It's coming.
Read Power of Positive Thinking and read Only the Paranoid Survive. Long-term, everything's going to be fine. Short-term, these rates are going to get to 10 points. I hope I'm wrong. Believe me, because I'm trying to also participate. I've taken a hit on a few of the properties I bought. I hope I'm wrong, but it's going this direction.
All right, guys. I know that was a long clip, but I thought that they did a masterful job, guys, at kind of unpacking that. Okay, they did a masterful job there. Okay, the buying power people have lost 40% buying power. He's not lying at all, guys. He's for real. This is for real, guys. You saw. I've been telling everybody, to be honest with you, when it comes to in the real estate sector. Whenever you infuse so much cash into the market, it's fake success because it has no way to go through. That's why you have inflation, guys. This is real simple. This is not hard. Right now, I agree with him. I've taken a hit on a couple of my properties because of the high interest rates. So now I've adjusted my expectations. Now I've made my investment strategy not based on a 5 or 6 or 7% interest rate. I based mine on a 10, 11, 12% interest rate. And this is whether I'm buying a commercial real estate, apartment complexes, a new construction land. New construction is 12.5. Easy. You know what I'm saying? So I'm actually making my projections, making my investment strategies based on a interest rate of 10+% easy, because that's where we're going. That's where we're going, guys. That's where we're going. So didn't want to scare you guys that much at all, period. I know I've given you a lot of bad news, but you know, the name of this podcast is called The Countermove. So guys, what is the Countermove? I'm glad you asked. I actually, just like we brought in some experts to unpack the problem, let's bring in some experts to prescribe some solutions, okay? And more than ever, I want you guys to listen to me on this one here. You don't have to, you don't want to, because I ain't your daddy. But at the exact same time, you can either put your head in the sand and hide and hope for the best, or you could be a wise person and you can have hope, but begin to prepare for the worst and widen the circle and inviting that wise counsel. I hope that I'm adding some value for you so that I can be part of that wise counsel if needed. Okay. I, I wanted to bring in the first counter move. And folks that know who I am, I'm going to keep saying it with my chest. Okay. The first place you need to go, guys, is life insurance investing. Guys, right now, the market is getting destroyed right now. Market means stocks. It's getting destroyed. 401ks, IRAs, Roth IRAs, 403bs. These guys are getting slaughtered right now. I understand. I know. So I'm bringing in some folk, man, to help you guys out with this thing. The first guy I'm gonna bring in for a brief second is my man's and them, my man Matt Zapala. He spoke with one of the leading experts in life insurance. He's been in the game for 30 plus years, guys. And I want you to kind of listen to what he said and listen to who also used this as well. All right, here we go. And this guy brings in specific a skill level that talks about life insurance investing in down economies, not just in up economies, in down economies, actual real world experience in this type of strategy. Okay, here we go.
He saved Disneyland by using access to the cash values out of his insurance policy. J.C. Penney did it. Ray Kroc, McDonald's did it. David Walker is the comptroller of the. He said, "I'll tell you money in max funded universal life."
Wow.
He came so close to a financial collapse in 2008, and he said to America, "This is where I put my money. Don't follow the herd, putting money in IRAs and 401ks, and don't listen to the mainstream media because they're part of the herd." And people get hung up on what it is instead of what it does.
Ooh, key point.
It's not costing, it's making you money.
Investments. Ooh, man. Okay, yo. That was a brief taste of that thing. Okay, man. Yes, sir, man. Listen to what he actually just said. He said, you're not losing money, you're making money. It's an investment. That's why it's called life insurance investment. And he actually said something that was very key. He said that Ray Kroc, you had Walt Disney World. Walt Disney World saved Disney World by gaining access to his cash value life insurance policy. The U.S. Comptroller, he listed his name, actually told you where to invest your money into cash value life insurance. Okay, all right. Now, for those that may not know what this is, or you may know what it is and you don't know how it's going to work, hey guys, I wanted to bring in my partner. I gotta bring in somebody that can show you what's going down, guys. On this, he's brilliant when it comes to this, guys. My man, let me go to him. Deontay Ford, man, he does a phenomenal job at breaking down, okay, the value of cash value life insurance. Okay, so we're gonna let him talk about this real quickly, guys. Here we go.
Talk about this feature enough. Principal protection is exclusive to indexed products, which will be indexed annuities or indexed universal life insurance. Traditional retirement accounts, IRAs, Roth IRAs, 401ks, 403bs, 457 plans, TSPs, none of those vehicles offer protection on your principal.
Did you hear what you just said? None of the vehicles that you may know of, guys, that's known to the masses in a broad basis, and he listed them out, protects your principal. Man, keep going, Deontay.
Now, the IUL offers a variety of different index crediting strategies amongst various carriers that allow you to link your cash value to major stock market indexes.
Come on.
With a built-in 0% floor, meaning you're able to capture the upside of the market up to a cap and cap strategies and uncapped strategies. But you always have a floor that protects you from loss in the event of market downturn.
He just told you something that was very important. You have a floor and you have a cap, okay? And you have a floor that's zero and you have a cap that may be 10, 11%. Most likely is about 10%, okay? Consult with your CPA and your financial advisor. I call them really a wealth strategist, like a Deontay Ford, a Matt Zapala, a Mario Dediglio, Alex, or Brandon Anthony Clark. If you need somebody, let me know. I can refer you to people, okay? But he said something that was very, very important. Protection of your capital, okay? In the event of a downturn like now, Those that have their money in an environment that is as a floor will have their money protected. That's why it's called investing. All right.
Principal protection is exclusive to indexed products, which will be indexed annuities or indexed universal life insurance.
Yes.
Traditional retirement accounts, IRAs, Roth IRAs, 401.
So he's going over that again. Okay. All right, guys. I want you to understand what he's talking about. That is pivotal to what was going on. So I wanted you guys to see exactly what they're talking about. Now, I want to change your thinking a little bit more, okay? On this is a lot of billionaires and millionaires, they don't have their money in banks because, again, when it comes to money, you want your money working hard for you, okay? Well, let's look at how it's performing in the bank. You're getting less than 1%. Not work hard for you at all, versus it being in a proper environment like a life insurance contract, okay? And I'm actually going to do maybe a kind of move just on life insurance to give you a little bit more information. I'm going to invite on some individuals where they kind of go in a little bit more depth about this, what it may look like as well also, okay? But in a life insurance environment, what happens is again, your money's protected, but also it increases tax-free. I don't know about you, when it comes to investing, I don't like to lose my principal. Do you? I want my principal protected. That's called security. I want my asset secured by something, a contract. Okay. All right. And life insurance has survived the Great Depression, many recessions. Matter of fact, life insurance actually grows more in recessions. So guys, that's just, again, that's why I call it life insurance investing. Change your mentality from what someone may have told you about it and really look at life insurance as an investment, not for when you die alone, but while you're living. Okay. All right. So here's my second counter move, guys. Y'all know real estate investing, guys. Man, I don't know about you guys. Banks will not loan you any money to buy stock. They won't do it. No. Now they'll leverage some stock to give you some capital, but you have to have some stock. But they will not. If you go to the bank and say, I want to borrow $100,000 to buy some stock, they're going to look at you and laugh. But they give you money all the time for a tangible asset like real estate. All right. So let's look at let's go to Cliff and I. We actually did a real quick short on the condition of the market, but I want you to pay attention to the end, to what we say at the end concerning the current market. Okay, here we go. All right, let's go back over here. Boom. Here we go. Let's see. This is me and Cliff talking about the current market, but pay attention to the end. Here we go. From the ground's perspective, what's going on in the market from an appraiser standpoint?
This week, they raised interest rates again, about 75 basis points. I think they're going to continue to raise them until they get inflation under control. I think they're serious about that. Today's interest rates might be a good deal. I wouldn't be surprised if they raise it another 2% from where we are now to try to curb the inflation. It's picking up a little bit, but we're still in a slowdown. I think right now the Fed's going to crush the market. I think they're going to try to drain out any excess money in the system. What they're doing is they're trying to slow the market so slow that people are not purchasing nearly as much. So when they do, it looks as if inflation is low. I mean, I'm seeing $400,000 houses knocked off 40,000 so far. So about 10% in Dallas. We're in a strong market. I'm seeing that already. You know, the average buyer could own a $400,000 house 6 months ago. 400, maybe up to 500 tops. That was the average buyer in that range. Them raising interest rates and the payment staying the same, that could easily drop to 300 to 400. We could lose $100,000 in equity because of the interest rates, and it just comes down to the buyer. Problem is, people have their income that's not caught up with the inflation, so they can't afford the prices they could before with the high interest rates.
I want you guys to begin to look at how the market is responding. If you still see the inflation rate still going up, these raising the basis points, not doing anything at all, I believe they have to get more aggressive. There. Kind of agree with Cliff on the 2 additional basis points. I think it should be at least 3 or 4 because there's so much cash, so much manufacturing manufactured cash flow in the system, they have to burn it out. We are pretty excited about what's coming because more opportunities are going to come. We're seeing them now. So, guys, for us, I want you to pay attention to what I said at the end. Is we're seeing a lot of opportunity now because of the fact that we make money in up or down economies, and whenever there's a recession or a depression, what actually happens is the sophisticated investors, the one that actually are ready for that recession. What happens is we get those properties below wholesale. I give an example. I get emails from Grand Homes. Grand Homes is, I believe, one of the biggest, if not the biggest, builder in Texas. Okay, or in the Southwest United States. I got an email from their new builds. Okay, new builds already built. Okay, they lowered the price point $100,000. $100,000. That's why when it comes to my investment strategy, when it comes to real estate, I know I can buy below wholesale because people have to sell. The buyers have shrunk. And the only ones that are actually going to be able to survive and succeed are going to be those sophisticated investors that have the education, or those investors that have the mentorship of a sophisticated investor that put together a team that can maximize their return. But even if you can actually combine life insurance with real estate investing, and you really dangerous, then you got so many opportunities, so much yield with so much security. Man, it's attractive for cash to be invested that way, if that makes some sense, guys. All right, but let's bring some additional experts on why they do this, guys. I'm gonna bring in President Trump on this one because of the fact that he talks about the benefits of investing in real estate. Let's listen to him.
How important do you think it is for this audience to have real estate as part of their portfolio?
Listen.
I think real estate, Grant, is got to be part of a portfolio.
Yes.
It's been first of all, there are tax advantages, depreciation. A lot of people, you'll look at a project and you'll have a loss. Now, not good for your ego, but it made money, but you don't pay tax, and it shows after depreciation you have a loss.
Yeah.
A lot of times they'll analyze my stuff. They'll say, "Well, you lost money." I say, "Yeah, I lost money," but you're not losing money. You're in fact, that loss you can carry it over to other jobs.
Yes, you
when
can.
you're making a profit. So, real estate, from the standpoint of tax benefits, has been great. But I love the real estate business. I love the creativity of real estate.
Yeah.
And I think I always will. Even as president, I'd say, "Boy, that's a great site for a building." Right?
You still see sites and like that's a good location.
Everything I do, I mean, I see so much. I'll look at something, and that's what it was.
Listen, y'all, listen.
From
Just getting
the time
wisdom.
I'm very young, I loved the creative process of building. Inflation has always been very good.
Inflation.
For real estate. But unfortunately, at the end, the whole thing pops.
Yes,
That's the
he's
bad
right.
part. And you haven't seen that yet, and hopefully you won't. Hopefully changes will be made, substantial changes, and you won't see that. But inflation is a good thing for real estate, not a bad thing for
Very
real estate,
good.
okay? So I have to tell you, this inflation, but it's bad for other parts of the country, and it's very bad. Ultimately, it explodes. Inflation is wonderful until it all explodes. And you got to be careful of that. You have to watch it.
What do you think about?
So he talked about a lot there, guys. He talked about the tax advantages of real estate, where you can actually lose money on a project, which has happened to me in the past. And take that loss and roll over to a project that's making you money, and you can write off those losses. You can write off depreciation. You have tax credit when it comes to green energy as well, guys. There's so many tax credits and tax advantages in real estate because the government does not want to be involved in real estate investing. So they'll say, "Hey, Liddell," or "Hey, you. Will you invest in real estate, provide housing for the masses, and we'll give you the tax breaks or the tax incentives for you to do that?" That's why I love real estate as well. That's the exact same thing also when it comes to life insurance, if structured the right way. But also, guys, let's bring one last guy in here. And this one right here kind of surprised me because this person's been investing in real estate for a long period of time. Young Jeezy, man. Jeezy, he invested in real estate. Listen to what he did with his checks when it came to real estate. Listen, guys.
It's sitting in the bank or sitting in the safe and it's not working for you. It's not doing anything.
Mm-hmm.
And that's what and by the way, it just like, I had to build that up. My credit line is sick. You know what I'm saying? If anything was to ever happen, you got crazy credit line. Then also on top of that, it's like you got equity.
Yeah.
I almost own most of my properties flat out because every big check I ever made, I put it back into my properties, my real estate. And I just think, you should own something. You know what I'm saying? You should have something, because even if you do have a bunch of cash in the bank, anything can happen.
Yes.
I mean, one time I had got into some legal things, and I went to go open my safe deposit box, and they wouldn't let me open my safe deposit box. You know what I mean? Because I had a lawsuit. And that was real to me. I'm like, that.
So guys, you just heard him there, is when he had cash in the bank, and he had a lawsuit come against him. And when you're in business, lawsuits can come very easily, guys. And because it could be a frivolous lawsuit, it could be anything at all. And what will happen is they can freeze your cash in there. So that's another value of real estate. Now, here's the big thing about life insurance. They can't touch the cash in life insurance. Now, do you see the reason why? So if someone wants to sue you, you have a lawsuit, they can't freeze the cash in your life insurance. They can't touch it. They cannot touch it at all, guys. At all. It's lawsuit friendly. Yo, it's, man. I say this, guys, and I'll end this here. I know this has been a little bit longer than expected Countermove. I say this, guys, for this reason. It's time for, if you have not, it is time for you to invite in some wise counsel. It's time for you to maybe put that pride down, take a realistic look on what's going on, widen that circle, inviting in a wise counsel, guys. For you can then say, okay, tell me where my blind spots are. Tell me what I can invest in. If you have cash, whether it be in a 401k, IRA, Roth IRA, 403b, get with the wealth advisor to see what you can do with that cash to get into the right environment. That would be my advice there. Number two, I would begin to invest in real estate education. Okay, get the education you need for real estate. Okay, and that's if you want to invest in from a passive standpoint. Look at different funds that you can actually partner with someone that you can actually trust and make a nice amount on an annual basis from a passive standpoint. Or if you want to get actively involved in real estate, still get that real estate education. But joint ventures are going to be the bedrock of anything now, guys, because once you have a joint venture structured the right way, you can acquire a lot more properties a lot faster. Okay, guys. So I hope this added value to your day. Thank you for your time. And again, before I always say this, guys, as I'm ending, before you leave, and while you can, you know where I'm going, y'all. Take that picture for your mama and them. Now holla at your partner.